Life and Health Insurance Exam Chapter 1 Introdo. Avoid risk. Avoiding an auto accident by never driving a car. Not all risk is avoidable. Indemnity. Concept stating insurance should restore the insured, in whole or in part, to the condition he or she enjoyed prior to the loss. Restoration may take form of payment for the loss or repair or replacement of the damaged or destroyed property. Mutual company. No stockholders. Commercial formation funds must be contributed by someone or some group. Ownership rests with the policyholders. Participating companies. Policy owners participate in dividends. Pure risk. Possibility of loss only. Type of risk that insurers accept. X. Possibility of financial loss due to an accident, sickness, premature death. Insurance's purpose is to make those who lose whole again, restore the insured to their original financial position. Peril. The cause of a potential loss. X. Fire, accident, explosion, flood. Transfer risk. Harmless agreements or lawsuits. Speculative risk. Risk that offers the opportunity to gain as well as the possibility of loss. Gambling is an example. Legal hazards. Arise from court actions that increase the likelihood or size of a loss. Life insurance. Coverage on human lives including benefits of endowment and annuities, and may include benefits in the event of death or dismemberment by accident and benefits for disability insurance, designed to protect against the risk of premature death. Hazard. Condition that increases the seriousness of a potential loss or increases the likelihood that loss will occur. X. Slippery floors, improperly stored gasoline. Stock insurers. Commercial, consist of stockholders who own shares in the company. Non-participating company, policyholders do not participate in dividends. Retain risk. Happens when someone assumes financial responsibility for certain events, insurance deductible and health plans. Casualty insurance. Protects the insured against the financial consequences of legal liability, including that for death, injury, disability, or damage to real or personal property. Actuaries. Mathematicians who study and compile statistical data regarding exposure units and risks. Why loss must be ascertainable. Because the purpose of insurance is to reduce or eliminate the uncertainty of economic loss, economic hardship and magnitude of loss. Nature of the loss must be such magnitude that it is worthwhile to incur the premium cost. Property insurance. Protects against financial consequences of the direct or consequential loss or damage to property of every kind. Moral, hazards. Arise out of carelessness/irresponsibilities, no seatbelt. Risk. The possibility that loss might occur, reason people purchase insurance. Accident and health or sickness insurance. Protects against financial loss caused by sickness, bodily injury, accidental death, may include disability income benefits. Limit of liability. Not used in life and health, commonly used in property and casualty, means the maximum amount the insurer will pay for his specified insured contingency. Physical hazards. Arise from material, structural, operational features of risk situation, slippery floors. Loss must be uncertain. How uncertainty arises. Out of not knowing what is going to happen or being unable to predict what is going to happen to the individual or exposure unit. Moral hazards. Arise from people's habits and values, false claim. For ways of managing risk. Avoid, reduce, retain, transfer. Law of large numbers. The larger the group, the more predictable the future losses in the group will be for a given period of time. Insurance. Business that was developed as a means for spreading the result of financial loss among many persons so the cost to any one person is small. Catastrophic perils. When these perils cause losses, they do not establish a pattern of predictability that can be relied on for future predictions of anticipated loss. Credit insurance. Limited line of insurance, protecting insured/creditor against the financial consequences should a debtor be unable to pay their debts due to illness or death. Service insurance. Technically not insurers, organizations providing prepaid plans for hospital, medical, and surgical expenses, no cash benefits to plan subscriber, pay the provider of medical services used by the subscriber to the extent covered in the contract. Blue Cross. 3 major insurance sources. Private commercial insurers, profit-making, private non-commercial insurers, non-profit service organizations, and the U.S. government, special non-profit. Insurable interest. Before an individual can benefit from insurance, that individual must have a legitimate interest in the preservation of the life or property insured, necessary for the law of large numbers to operate. A large number of similar risks or exposure units, item of property or person insured, be combined. Reduce risk. Control, examine perils and see which ones can be eliminated. Health problems identified in a workplace lead to customized wellness program. Variable life and variable annuity products. Include insurance coverage provided under variable life insurance contracts and variable annuities, carry investment risk. Coinsurance. Within a specified coverage range, the insured and insurer will share the allowable expenses. Commercial insurers. Private life and health insurers, in the business to make a reasonable profit. Deductible. The initial amount of a covered loss or losses that the insured must absorb before the insurer begins to pay the additional loss amounts. Annuity. Guaranteed income for the life of an annuitant, designed to protect against the risk of living too long, outliving financial resources of income during retirement. Non-commercial insurers. Operate on a non-profit basis. Blue Cross Blue Shield is an example.